This is the Evidence-Based Investing Podcast, the show that challenges assumptions and puts every strategy under the microscope. We bring in the experts, we bring the facts, and we break down what actually works depending on where you are in your wealth journey. If you want hype, this isn't your podcast. If you want the truth, well then welcome aboard. The information in this podcast is for educational purposes only and does not constitute financial, tax, or legal advice. We discuss general investment concepts and share case studies, but your personal situation may be different. Always consult a qualified financial advisor before making any investment decisions. Past performance is not indicative of future results. Welcome to the Evidence-Based Investing Podcast, powered by Retain Property. I'm your host, Luke Ryan. Today we have on the show Yousof from Flint Invest, and we are talking about trust lending, the rules and regulations that are changing at the moment, banks pulling out of trust lending completely, or at least pausing it. So let's dive into it. Welcome to the show, mate.
Thanks for having me, Luke. Good to see you.
You too, mate. You too. All right, so lots of news in the media lately. Macquarie Bank has just pulled out of trust lending. I understand that they were a favourite amongst brokers because they would allow you to be guarantor of one trust and then get that to neutrally geared, self-declare it, and then do another one and do another one and do another one internally, where in most other cases, banks would only allow you to do that once, and then you would have to use a different lender to buy another property in a different trust. Have I got that right?
You nailed it.
Pretty much anyway. Close enough. I'm not a broker. What are some of the benefits of trust? Why are people scrambling at the moment? Why did Macquarie pull out? What's your 2 cents on it?
Yeah, so I love to just give more context behind why this has become such a hot topic very recently. Something we've talked about already.
Finfluencers, apparently.
Mate, finfluencers, some or most probably not like ideally talking about it too much,
yes.
Which we've seen. But I think if we look at just in general the last 15, 20 years prior to this entire hot topic of trusts, it's always been something that's been utilised by sophisticated investors.
I mean, I've got a couple other companies, and we've had finance inside of other companies, and I've had to get letters from accountants to say that these entities are self-sufficient, and then I could just exclude that to go for a loan on something else. So it's nothing new for business owners, company owners, or people that have had trust before. It's only recently now that it's come to light for property investors, and it's become, I wouldn't say common knowledge, but more common knowledge.
Much more, yeah, absolutely. And I'd probably say 1 out of 2 investors on the phone know about it before me explaining, whereas maybe 2 years ago, it was only 1 out of 10 people that knew about the concept. So like you said, Luke, with your scenario, primarily was for sophisticated investors or commercial investors who would put down 30 to 40% deposits on residential property, be positive cash flow, or it could have been for certain clients that wanted to achieve long-term tax efficiencies, as well as asset protection as well. Now, I think what we've seen over the last few years, especially post-COVID, is we've seen obviously the rise of social media. We've seen a lot of investment specialists come to the limelight, and they've been really promoting these strategies like borderless investing, rent vesting, which I'm a proponent of myself. But the extension of that is then lending, and what lending structures and vehicles are needed for a client to do X, Y, Z in the shortest amount of time possible. That's where trusts have been birthed as this crazy topic over the last 12 to 18 months. And like you said, we've seen certain front-running lenders like Macquarie Bank strip away from it. They've actually said the word pause, freeze, but we'll see how long that lasts for. Yeah. To give you an idea, Macquarie, they're a global bank. They have been growing at 3 times the pace of Commonwealth Bank, which is Australia's leading retail bank, both their lending books and their deposit books. And a big portion of that has been from company and trust loan applications in 2025.
Yeah, so, and that jumps into the next thing. So then APRA's come out, they've brought out some regulations where they want to see for, I think it was 80% of the major banks' loan books, they want to see a 1-to-6 debt to income ratio. Have I said that right? Only 20% of their clients or applications can be more
Correct.
than that?
Yeah. So just to give people the definition, so DTI or debt to income ratio, very simply, if you're earning 100 grand, you can borrow maximum of 600. It's a 6 multiplier on the income that you're earning. Now, that income could be, your salary, or it could be your salary plus the rental income from your properties. The interesting thing about the announcement is not just this announcement in isolation, but it's been this announcement plus certain lenders stripping away from trusts, as well as the macro narrative that investor levels right now, it's at 40%, which is very similar to 2017, which is where we started seeing APRA intervention at that point of time. So it's like we're going through something similar right now. The interesting thing about the capping of the DTI policy, which is to come into effect in February 2026, is they've said that only 20% of borrowers can't exceed that DTI of 6.
So how do they pick?
It's a good question. Don't have all the information on that yet. You could probably just apply as 5 mates all at once, and one of you will just get the bad end of this form. Yeah, so different lenders will have different, risk metrics internally and decide how they're going to do it.
Yeah.
There's 2 buckets. So they'll do it for their owner-occupier application bucket, and they'll also have it for their investor bucket as well.
Mm-hmm.
Now, a couple of things on this. So there's certain lending facilities that are exempt from this. So construction loans are one category that's exempt. But it's not the be-all or end-all, this announcement. And the reason for this is because right now, we're still in a very high interest rate environment. People who go to banks, the ones regulated by APRA right now, they're not able to service for the lending to get anywhere close to a 6 DTI at the moment, the average investor. They're probably capping out at about maybe 4.5, 5 debt to income ratio right now. And the reason for that is because we've got something very cheeky, which is a 3% buffer, which was also introduced by APRA in the late 2010s. And that's what's restrictive at the moment. Now, if I compare 2021, when rates weren't 6% and they were maybe 2.5%, DTIs were getting as high as 7.5 or 8 at that point of time. So that's where you'll see the actual restrictive effect of a DTI cap when rates probably cool off a little bit. As to when we'll see that happen, who knows? Because there's talks right now where the rate cutting cycle is over. We'll probably, see maybe some rate hikes. But maybe in 5 years, if rates somehow do come back to 3.5%, 3%, and then we see the DTI caps having their restrictive effect, it's not going to be a controversial announcement anymore, because that announcement was made in December 2025. But everyone was aware of it. So they're probably just stripping away the controversy of it, announcing it in the future, and bringing it into effect now.
So it's not as bad as what it's being played out to be in the media, in your opinion?
It's not going to change much for investors. And to be honest, Luke, what we do for a lot of our clients is, by the time you start approaching, that debt to income ceiling with a major lender, you're also at that same inflection point where we're having the conversations of exploring more flexible lenders like Resimac, FirstMac, Brighton, MA Money. These lenders are not regulated by APRA.
The non-bank lenders?
Non-bank lenders, specialist lenders, and they don't have DTI caps as well. So at that point in the conversation, most investors know that they need to pivot with lender sequencing. So it's a bit of fear-mongering at the moment with the announcements.
Yes. So far, who we've got out? We've got Macquarie, we've got CommBank who've announced it. Who else?
This is interesting because Macquarie being the front runner, and the reason for Macquarie being a front runner is
they were biggest in the space.
Biggest in the space. You get 24-hour approvals with Macquarie for trust applications, which is just bizarre. And, when you've got, clients and, you would know this, working between that 500 to 750K range where there's so much competitiveness in the market, finance clauses are super important. And if you have quick approvals with lenders, it's going to support your ability to pick up deals faster.
Absolutely.
Macquarie was preferred for that reason. They gave you offset accounts. They gave people the ability to buy multiple properties in separate trusts internally with Macquarie, and the ability to not go off to an accountant and get a letter, but for them to self-declare that the entities are self-sufficient so they can just keep the journey going. That's probably the reason, over time, they've seen alarm bells going off that, hey, we need to reduce our appetite towards this particular lending product. What's fascinating is, though, in February 2025, and this probably isn't common knowledge because it wasn't as controversial as Macquarie coming out, is ANZ had jacked up interest rates by about 75 points on company and trust loans.
Right.
And when I saw that happen, I thought to myself, I'm like, ANZ, a lender which is very commonly used for investors because they're very flexible with their LVR levels, their equity release policies, for them to start making it more expensive to have company and trust loans, I think
something's in the water.
Yeah, something might be in the water. There were certain occasions I would see some other lenders report the company and trust debts, which is a separate entity, into a client's personal credit report. Wow. So you would see the debt, and that's not meant to happen. Whether that was done as an error or was intentional, I don't know. But when I saw that with the ANZ thing happen, I thought, okay, it's good just to be on guard. And when you speak to clients, to obviously give them the scenarios of buying in trust, buying in personal, but also just let them know to never put all their eggs in one basket, because if everyone strips away and you've just cemented one strategy for yourself, what's your alternative plan now? So,
have you got any clients that are coming up to the interest-only period, 4 years or whatever it is for their bank, and they need to go to P&I and they're now panicking because they're not sure if they can refinance? Say they've got 5 or 6 investment property loans with Macquarie Bank, for example, and they want to refinance again. What's their situation? They just got to go to another bank, or they just go to P&I if they can afford it?
Yep. So they can refinance internally with the lender, even though it's within a company and trust structure at the moment. But without any actual dollar increase during that. So if they're purely just extending the interest-only period again by a few years, then it's okay.
Right.
That's the feedback I've been given from the lender BDMs. Now, early days. Mate. We've seen lenders move so quickly and strip away policies.
By the time the podcast comes out, that'll probably be wrong, but anyway. No, it's all right.
But I think regardless of that, you've got options outside of CBA, Macquarie anyways at the moment. You know, there's a whole host of different lenders that are still comfortable to do it. We might see the domino effect with, most of the APRA regulated lenders or the major banks pull out. We're seeing that. But similar to what happened in the 2010s with the majors pulling out of SMSF lending, the market share for the non-banks started to pick up in that space. And now it's like no one...
And what's also interesting is what I've seen is that the interest rate difference between some of these non-bank lenders compared to the major four are getting less and less and less. It was some time ago, it was quite a big jump from the interest rate from one to the next. What are you seeing now? Like, what's the difference between a major bank loan compared to one of the non-banks? Like, what's the difference in interest rate that you're seeing typically now?
There's scenarios, Luke, where a client that might borrow at a 90% LVR might actually get an interest rate which is a few points lower than what a major bank would lend as well. Especially if we look at ANZ, for example, which we mentioned, they put that loading on the interest rate. So product-wise, you've got lenders like Resimac that are doing low sixes right now for 95% interest only for investors. Probably not as sharp of a process with them, maybe compared to a major lender. But at the end of the day, as an investor, we want to get our money, but we also want to have them back as well.
And would you say that's because the non-bank industry is just taking more of the market share? They're just now bigger and they can afford to?
I think over time, they've probably seen the data and they've probably seen the sort of applicants they get. And because it's investors that are looking to build portfolios, those are predominantly the ones that are seeking those non-bank lenders. So they've identified that and they've thought, let's actually give them the products that'll support more of that market share for us.
And it'd be arguably safer from an asset protection point of view if they're lending to somebody in a trust anyway, right?
That's right, mate. And at the end of the day, like as investors, it doesn't matter who it is, as long as they're giving us the money we need to buy the asset that we want to support our long-term goals. That's what we should be focusing on. Yeah. The risk is for the lender. They're giving us the money. So sometimes people have this preconceived, perception that it's risky if I go with La Trobe or Liberty. I think it's just a mindset shift that people need to have, and probably now they're going to have, because if the tier one major banks are now stripping away from this type of lending, your only option now is these other lenders, which most investors are okay with now, but we'll probably see more people now flock in.
All right, so let's go jump into some tricks of the trade that you can do in the lending space.
I'm going to have APRA on me now. We use the word tricks.
Look, I did it. So I was in a position once where I knew that I wasn't going to be able to get the finance to move from one property to the other, but I wanted to sell down. And I wanted to keep that loan facility in place. So instead of actually selling down the property, paying off the loan, applying for finance again to get into another property, what I did is I rang up the back and said, will you port the security of this mortgage from this house to this house? And they said, yes, you can. Spoke to the conveyancer. They put I can't remember the clause, something like contemporaneous settlement, but basically means that the very second that property settled and I sold it, the new property that I had a contract on settled at the exact same time and second, and the money from the bank, they just said, righto, we'll keep your loan in place, but now we've got security over this property rather than your old property. Explain how that works. Do you guys do it? Do you help with it? What's the benefits?
Yeah,
Is there any negatives? Portability.
Yeah, portability. So portability are also commonly known as security substitution with certain lenders as well. Basically, we do it here and there, especially in scenarios like that. It makes a lot of sense and it can be very strategic. But I'll give you maybe another example, which we did actually very recently on the topic of it. So there was a particular client we were working with in 2021 who bought in Perth, 500k property in Seville Grove. The loan was 400k, interest only. Now that property has now grown and appreciated to about $850,000 in 2024. The loan is still $400,000 at the moment, but the client understands that maybe Perth has done the majority of its run over the years, and now it's towards the tail end of its growth left in the cycle. Whether that's true or not, we don't know, but it's just an investor sentiment. Now, what they feel is they could probably get more growth by repurposing their lend against a new property, maybe in Melbourne, to achieve more growth now. But they're not currently working. They don't have income. Yeah. They're on leave. So what they've done is, and what we've supported with, is basically the portability process, where you can sell the asset, so sell the Perth property, you bank the profits, but you keep the loan open. You don't discharge the mortgage. You keep the facility open, and you can keep it open for a maximum of 6 months.
Oh, right.
Yep. There's a few little conditions and caveats with certain lenders, but that's the rule of thumb. Keep it open for 6 months, but for most investors who work with, people like yourself, 6 months is, very long.
Well, I did it the same second, literally.
Yeah, mate, you did it the same second. So super impressive. But now the client doesn't need to reapply for a new loan where the banks are going to say, no, we can't lend to you because you don't have income. You can't borrow anymore. He's held that loan open. It's now acted as his lever, plus his profits from the sale has now allowed him to get into a property purchase price of maybe 750k, which he wasn't able to do initially when he started that journey. Now he's probably appreciated that property close to about 950k in Carrum Downs in Melbourne.
Yeah, perfect. Good spot.
It's an interesting strategy if you know how to utilize it. Some of the benefits, one being you don't have to reapply for the serviceability, but also, we saw clients who might have been on 4-year fixed terms
at a really good rate. I don't want to get rid of it.
Yeah, at a really good rate, maybe, high twos, or possibly if you did really well, 1.99, retain that interest rate, retain your holding cost position, but port it over to another security, which makes more sense to buy now at this part of the market cycle. Yeah,
that's really interesting. I hadn't thought about it from all aspects like that. I just did it because I knew I wasn't going to be able to get finance. I was literally in a hospital bed at the time, so
yeah.
Just woke up from surgery.
But that's the thing. I think the more you know, and the more you go through your own investing journey, or you have a broker that has the ability to present to you these. Not policies, this is probably more of a process, I would say. But just nailing the three, which I talk about, product, policy, and process, you can do some pretty cool things, just depending on where you're at in your own journey. And that is one of them. So I'm glad you asked the question.
Fixed rates moving forward.
Yep.
There's some talk in the media that interest rates probably are more likely to go up in the short term rather than go down in the short term, which I wouldn't have picked 6 to 12 months ago. But inflation's going back up. So would you fix right now? Would you not fix? What are your clients doing? Are you getting a lot of calls about it?
Yeah, so the conversation has picked up much more now by clients asking about it.
Yeah.
And what we've seen is with 2 consecutive months of inflation data coming in at the mid threes, it's created concerns now that there's going to be rate hikes in early to mid 2026. Something that wasn't even considered, even 2 months ago.
Yeah.
Which is absolutely mind blowing. So clients are actually thinking, should I fix my loans because I don't want to have more holding costs on this already negatively geared property, or they might have trust loans right now and they prefer to maintain that level of self-sufficiency, so they have to fix it. I think it does make sense in certain situations like that. The only times where I would challenge fixing even then is as an investor who's still prioritizing the ability to build your portfolio and have equity releases there, have a modeled out plan of equity extraction in 3 years' time. You want to make sure that you don't fix for maybe 5 years, if that's what the modeling is, because if you do that, and let's say you're with a lender like NAB, and then you're fixed with them for 5 years, and then you need to go to CVA to get an equity release in a couple of years' time, you might have to pay a pretty big fee to break that loan because you fixed it.
Yeah. So for the listeners at home, what that means is basically, if when you're on a fixed rate, often you can't actually just go and strip equity out or refinance that property without paying fees to do it. If you're on a variable rate, you can do that whenever you want.
Exactly. So the variable product will give you flexibility, the ability to refinance, release equity. You've got the risk of rates going up and down because it's a variable rate, whereas fixed gives you more of that certainty. You lock in your repayments. If you've got your wedding or big life event coming up in the next 12 months, maybe it does make sense to fix for 12 months. So you've got that ability to budget, but then you restrict your ability to refinance, release equity, keep the needle moving forward when it comes to building a portfolio.
Yeah. Something to think about, that's for sure. I probably won't be fixing yet because I do want to refinance, but I can understand. I mean, especially like if it's your PPOR and you've got kids coming or something like that and you just want that security, it does make a lot of sense for a lot of people in a lot of situations. But yeah, it's all personal.
And I think a good investor and a broker should be in communication, right? Not once every year, but once every month or so, I always say. Even that, maybe every couple of weeks with so many moving forces right now in the landscape. Observing the current spread between variable and fixed, and then just looking at it not on a rate front, but the actual denominator of what's important, which is the dollar repayment. That is more understandable for people.
Yeah.
And then they'll actually be like, okay, maybe it makes sense to just stay variable at the moment. And if I stay on variable, I can always fix it anyways, whenever I want to. But if I fix, I can't just revert back to variable now.
Yeah.
So you've got a little bit more freedom and wiggle room if you're still on variable at the moment, I think.
Yeah. So don't rush into it would be your 2 cents.
100%. Do the numbers, or get your broker to do the numbers.
Yeah.
And like one really cool product that I actually really like at the moment is NAB have 5.64% 1 year fixed, and they allow you to go to 90% as well.
Pretty damn good, isn't it?
So pretty sharp. And there's some lenders that actually give you an offset account for a 1 year fix, like ANZ. So some clients have been enjoying that, but they wouldn't go longer than 1 year at the moment.
All right, so let's jump into... I just want to do... I've got about 10 common misconceptions that I've written down.
Let's go.
So I'm probably just going to annoy the shit out of you because it's going to be all the stuff that you get asked all the time by everybody all the time. And I'm just going to give them to you.
Just another day in the office, mate.
Just another 10 in a row. All right, so... Is your borrowing capacity better if you choose interest only? My repayments are lower after all.
Yes and no for that one. So with major banks, your borrowing capacity will be lower if you're on interest-only repayments as opposed to P&I repayments. And the reason for that is because if we take an example of being on a 5-year interest-only period, the lender will actually calculate your borrowing capacity based on the remaining P&I term, which is
25 versus 30.
Which is 25 years. And not just 25 years, but they're buffering the repayments over 25 years with the 3%.
Of course.
So it's quite harsh.
Yeah.
With non-APRA regulated lenders, depending on which one we're talking about, they will usually apply a small loading, or some lenders like Liberty will actually take your existing repayments on debts that you currently hold. So if interest only is, let's say, $1,500 a month, and the P&I would be $2,500 a month, your serviceability would actually then increase with non-banks if it was interest only. So in short, major banks reduces, non-banks increases.
As any good consultant would say, it depends.
It depends.
Myth number 2. My borrowing capacity is much worse in trusts in all situations, at least by a couple %, isn't it?
Yes and no again. Generally, the nature of the trust vehicle is that you can't claim negative gearing in your own name. Mm-hmm. Lender calculators will also have the restriction of that. So, for example, if you could borrow $1 million in your personal name, you might be looking generally maybe 750, 800K inside of a trust, because the calculators don't have the ability to add back the negative gearing. Now, there are certain lenders, again, in the non-bank space that actually do that internally as part of their policy, so that your borrowing capacity in your own name and also the trust is the same.
Yeah, so look, I guess the common theme of what we're going through here is that there is so many different lenders, there's so many different options, and just like what,
and there's a solution.
1 or 2 bank, and
there's always a solution, and this is like the theme of the last 4 to 6 weeks, where people have unfortunately fallen prey to the headlines, and it's good to be cautious as an investor, but there's always a solution. There's always a lender that's going to give you the money. You just need to have the guidance to know where to go and when to go.
I like it. All right, number 3. I own a property with someone else that I am not in a de facto partnership with. That means if there is 800K of debt, I am only responsible for 400K of it.
With most lenders, they will take the full debt of 800K, especially if it's not your spouse. It's looked at a little bit more favorably if it's your spouse, but there are a handful of lenders where you can apportion that debt to 400K or 50% in this scenario. But there'll be a few evidencing requirements needed to be able to achieve that.
But in most cases, if someone comes across your desk and they said, I bought a property with a friend from school, and there is $800,000 worth of debt, they would come to you and assume they're only responsible for 400 of it, and you've got to have that hard conversation with them. Would that be fair to say?
Yeah, mate. And what actually typically happens is, on the phone call, they'll tell me they've got the 400K of debt, but once we've actually collected the information, the documents, and seen the credit report, it'll actually show 800K.
Yeah,
and that's when we're like, that's going to change the numbers quite substantially, but, it gives the education for the person.
Yeah, so if you are buying your first property with a friend from school, whatever, it can completely hamstring you for your second and third property, can't you? It can really be a real negative. I've seen it happen a couple of times now, and hard conversation to have.
Absolutely, yeah, very important.
All right, if I have a 500K home loan but have 500K in my offset account, I don't have any debt in the bank size, right? I should have my full borrowing capacity back.
Myth, and the reason for that is because you have the ability to take the money out and just go buy whatever you want to. So the debt is still going to remain there.
You still have access to the money.
Yeah, and you could be the best person in the world, but the banks are always going to assume that you're the worst and take things very conservatively when it comes to things like that.
Yeah, you could take off on a Europe holiday and spend 10% of that in 2 weeks, no problem at all.
And mate, it's very similar to like the credit card situation. People will have like, 25 grand Amex credit cards. They applied initially to get the points, which we all love doing, but they've got maybe like a $50 balance on it because they went to dinner on a Friday night, and the bank will take the full 25K limit.
All right. Non-bank lenders' interest rates are crazy, right? Like 9%, 10%?
Myth, I'm going to say. Definitely not 9 to 10%. So there's a spectrum of lenders. So you've got your majors, you've got mid-tiers, you've got specialist lenders, then you've got the ones which are probably on the very harsher side with rates. Like we were saying before, Luke, there's a lot of them that'll actually give you, 40, 50% more borrowing, but the rates might be just on par with major banks.
Well, we had a client the other day that we both work with mutually, and the difference from a major to a non-bank was 0.07%. And it unlocked another almost $600,000.
And that's the priority. And that's the priority. But look, you can get to the more, more expensive lenders, maybe like your Liberties and your Peppers, but it's really for a small percentage of clients that really need to go down that spectrum.
All right, next myth. I need to get a car loan or a credit card to build up my credit rating before I can get a home loan.
Myth, you don't need to do it absolute for the reason of getting a home loan. You can get a home loan without any prior credit history. Although, if you already have an existing credit card or a car loan, then by having the right conduct and having made your repayments, you would have obviously improved your credit position as well and maybe look more merit-worthy in front of the lender as well. But it's not the be-all, end-all if you don't.
It's not a hard and fast no. All right. I just went on a holiday and spent heaps of money. I need to knuckle down for 6 months to make my bank statements look good before I apply for a home loan.
Both. This one.
Depends on the lender.
Yeah, it depends on what you've been doing on the holiday. Depends where we went, what we did, what time, and what the transactions actually say. Now, as brokers, we'll always collect as much documents upfront as we can. Mm-hmm. And if we see things that we need to kind of clean up, we have those conversations up front as well. So that way we can put the client in the best position possible. Mm-hmm. Now, not every lender is going to need bank statements to be submitted to them.
Yep.
So we can rely on other income documents like payslips, but it allows us just to see the general spending habits of what the client actually has. And, you know, if there was a one-off trip, which most people do once a year, and that just coincides with the time that you're applying for a home loan, we can put commentary and say one-off discretionary expense, and that usually flies by with lenders.
You can explain the scenario, I guess, and in my experience, I've seen that be okay. It's more so the tip like $200 a week on freaking sports bet and things like that, or the constant money in the pokies every single weekend. That's where it becomes a real problem, right?
Potentially, yeah. And then they'll look at it more holistically. Like if your credit score's, 150, and they see recurring transactions in sports bet, and you know your bank balance is always low, your salary's going in, but it's all being spent, then it's more problematic than if you're, much more credit worthy in all other compartments, but you're still doing that. That's okay. It's not the be all end all.
Alrighty. I just started a business. I need 2 years of books before I can get a home loan.
Myth, very passionate about this one. Being self-employed, you should be excited about growing your business, but it should never obstruct your lending plans. And I've seen it a lot recently where people think they need to wait for 2 years, and we know how quickly the market moves. By the time they wait, it's very difficult, right, to get into the asset. So, look, there's different policies for self-employed. We can go off 1 year financials with certain lenders. We can go off pay slips if you're paying yourself a wage as a director, provided there's certain other conditions met. Some lenders, particularly in the non-bank space, once again, they'll have alternative document verifications where we might just need 2 BASs. Mm-hmm. The benefit of that might be your last year financials would have been probably not as strong as what your current trajectory is. Mm-hmm. So we can now rely on the true income of where you're currently at.
I like it. I've come across that one so many times now. So,
and just on that one, Luke, as well. So those sorts of products might again come with slightly higher interest rate, but if you can get in, let's say it's December 2025 with a couple of BASs or an accountant letter, you still have the ability then to refinance in, let's say, July 2026 when you get your full financials, and then we've got full scope of all the other lenders where you can then get a better rate.
Yeah, absolutely. I mean, in my eyes, where you do see it happen and where it definitely makes sense is if there's like an absolutely cracking deal that you just have to get into. If you think you can't get the money, speak to a good broker. You might be able to get it, and it might just need to be temporary that you need to pay that 9% if you really have to get into it. I mean, that's a high rate. But.
And something we always do, Luke, to give clients the confidence and the peace of mind is we can do some quick online desktop vals of that property and actually show them that, hey, there might be instant equity in your deal right now. So that 45 basis point interest rate increase of going to this lender over the next 6 months doesn't even come close compared to the equity gain that you're going to have when we refinance that back to that lender in 6 months' time when you have your financials ready.
Yeah. Actually, just while we're on that there, instant equity, how often do you see that actually come across your desk? On the ground, boots on the ground, how often do you do desktop valuations on properties and they've got equity from day one?
Yeah, so it's arbitrary, mate. Like what? So instant equity, I think it's just... It sounds very marketable, especially for clients.
Yeah, but it just
pumps them up. But, something which I think most people know, and if they don't know, is certain lenders have these automated valuation desktops where the valuation can come in much higher than what it would probably sell for. So it allows basically people to buy a property, let's say at 500K, But if you have a CBA automated valuation that's saying it's worth 550K, where if you settle and refinance straight away, you might be able to pull out an extra 40 grand of equity, so straight away. So there's instant equity there, but it's purely relying off bank valuations and metrics, not actual market data.
But, you know, if your plan is to leverage up as hard as you can and you want to pull your deposit back out, it's a strategy that can work. But don't fool yourself. It doesn't mean that because CBA said it was 40 grand more doesn't mean that you bought it 40 grand under market value.
Yeah, it sounds nice at the family barbecue and you get the pats on the back, but it helps us achieve what we wanted, which is to compound and build a portfolio quickly. You know, rip out the equity, go again. And if we can do that in quick succession, then, you know, you get to your goals faster.
I've still got the same wage, same career, no extra kids. My investment property I bought for 700K with a 600K loan is now paying for itself. The rent pays for all the interest and expenses. Can I have another 600K loan, please? I'm with NAB and I'd like to use them again.
Myth. Yeah, myth. If it was that easy, we'd be having a very fun time. So what is actually a true measure of your cash flow isn't the same as what a lender will assess it as, basically, especially major banks, right? So, you know, if your rental income is $500 a week, the lender might actually sensitize that to 80% and assess it at $400 a week. With regards to your repayments, if your repayments are $2,000 a month, they might actually put those buffers on top and sensitize your repayments to now be $3,000 a month. So you've got the two levers working against you in this case, where your rent is being shaded, but then your repayments are also being stress tested. Yeah. They do it for risk mitigation. They do it for you as well. If things were to happen externally and macro forces like interest rate rises and maybe tenants leave the property, those things protect you. But you know, it's not going to be I'm cash flow neutral or positive, so that the lender should give me an extra $600.
So in that example, for the listeners at home, to give that some context, right? The example was $2,000 is the actual repayments. They're going to look at it as $3,000. That's $1,000 a month. So you times that by 12. That's 12 grand a year that the banks are saying that you are essentially negatively geared, even though you're neutrally. And then you got the extra $100 a week that they're shading off your rent, which is another $5,200 a week. So you're now $17,200 negatively geared in the bank size in their calculators, even though it is actually neutrally geared at zero. And that's one of the main reasons why people will get stuck, is because if they're on a 100 grand income, the next time that they go to borrow, and like there's other metrics around this, and every bank's policy is a little bit different, but they might look at that 100 grand as now like 83 grand, and then the 83 grand goes down another 17 grand and so forth and so thing. And then all of a sudden you haven't got any borrowing capacity left.
Exactly, man. And this is where it's just so important. It's almost like when anything happens, just tell your broker. You know what I mean? It's like you've got a newborn along the way. Like, how much is that going to affect your borrowing capacity? Or you're going to get a lower bonus this year than what you got last year. That one small thing might just completely change the choice of lender for your next property. So it's always good to, you know, have those conversations as soon as possible.
All right, lucky last, and we'll finish it up. I just started a new job. I have to wait 6 months before I can get a loan.
Myth. One lender will actually take your employment contract at face value, provided that you've had history as well, employment history. Some lenders are okay with one payslip or your employment contract if there's been less than a 28-day gap between your last employment. Might be very difficult if you've had like a 10-year career break and you're just coming now for day one employment, then we probably need to wait about 3 months for the continuity.
Yeah. So there's still someone behind the desk at the end of the day that's going to tick or flick it, right?
Absolutely.
All right, mate. Well, look, that rounds it up. Thanks again. Really appreciate you coming down from Sydney to be on the podcast.
Mate, thanks for having me. It's been an absolute pleasure.
Awesome, mate. Wrap it up. Thank you.
Thank you. Cheers.